First, for those of you who are here for the first time, a short introduction what Vilnius Tech Leads is all about. So we're a meetup group focused on technology leadership. We believe that leadership is something you learn, not something you are born with. And we're here to provide a space for all kinds of technology leaders or as people who are aspiring to be technology leaders to meet, share, and learn. Each of our meetup has a team. Our previous meetup had a team of first-time managers, and today our team is equity. Each time we have usually 3 speakers. Today we have 4, and they share their stories on the team for the day. So as I said, today is our team equity. And equity compensation is, in its ideal form, a great way to align employee and company interests. But there are many ways to implement that. And let's hear from our speakers and let's try to understand whatever it's something that works in practice, how can it be implemented, what's good about it, what's bad about it, etc. So today we're going to have 4 speakers: Skirmantas, Kaspars, Elvinas, and Simonas. For those of you joining us here in person, you can partake in snacks and drinks. After each presentation, you will also have the ability to ask questions to our speakers. And for those of you watching us on YouTube, you can ask those questions in the YouTube comments section, and I will read them to the speaker. So then, without further ado, let me introduce you the first speaker, Skirmantas. Go ahead.
All right, can you hear me? Great. So thank you for introduction. And having me here. So my part tonight is a snapshot from financial perspective. So a quick introduction about myself. So, I worked, a lot of places from hedge funds to private equity to, establishing my own fund and working as commercial bank and doing a lot of private investments. But I guess the interesting part of myself, that I started investing for my own portfolio, I guess from 2000, from 15 years old. And that's quite, unique story, I guess, because, my mother used to brought me newspaper, which was like Verslo žinios, it's like a Financial Times in Lithuania. And back in 15 years ago, there was like limited access to internet and stock market, and just going back to the newspaper, cutting the quotes for the stocks, and basically gluing back to my, workbook and trying to take a look how exactly the stock market is trading in the Baltics. And all of that transmitted to all my key to finance and how exactly this is working. So all this experience was tried basically in very different perspectives of the financial world. So I guess I can tell you more about that from different angles, and from my previous experience from previous years, especially when I was working a lot of basically eye to eye, a lot of executives and trying to establish relationships and get some kind of equity partnership or some equity exposure by its mean. So there was a lot of human angle at this point, which is, I guess, the most unique at this story, and I would like to tell you the most. So I guess the right point here to start is, establishing key points, key concepts, what exactly we're talking about, what is the difference, just to get everyone on the same page. So today's topic is stocks and equity options. So essentially, we have to understand these two by the most. So essentially, the stock is the fractional ownership right of the company, you know. So if the company has 100 stocks and you own one stock of that, so you essentially own 1% of the company. So it's extremely straightforward and simple. The key point is that if you own 1%, you get 1% of economic value of the company. So the company earns 1 million, you get 1% of that is the profit is distributed, you know. So stock represents a fact of your ownership of the company. You know, this is the fact. Like, this information goes to registry, and it's, you know, in the books of the government, and it's, you know, the fact which cannot be changed by any mean, you know. So the key point is that it's ownership and it's fact. Other word that is used around this conversation is usually equity. So equity is usually about the value of the company. So this is the sum of your stock value from a particular point of view, you know. So if we're talking about the company's point, you know, so equity, company's equity is the how much company is valued, you know. So it's also can call it valuation. And, you know, it can be used from any personal perspective. So, for example, Thomas equity. So Thomas equity in the company is exactly how much his stock is worth in the company. So equity is more or less like what is the value of your stock or the company stock. The last thing about this this quick intro about the stock is that, you know, very important thing in this topic is like whether you're a minority or majority shareholder, you know. So if you're minority, so you have like 1, 2, 3, 5%, whatever. So basically you don't have any rights. Well, you have just an economic right to the profit, you know, you can sell it, this is an asset, but you can't make any, you know, decisions whatsoever, call strategic in a executive board. And usually it's not so easy, you know, going, you know, through the steps by time, you know, it's not so easy when you're not in the line with the management, you think different, you know, equity value is different, then you thought, and, you know, there's some kind of discussion in yourself, how you feel about that, you know. So we'll discuss that later in more detail, but essentially it's a very important point. And the option contract, you know, so option by its definition, it's definitely an agreement. It's not a fact. It's just agreement between, you know, two parties, and the two parties agree that something will happen in the period of time in the future. So you have like some company under discussion, some share price, valuation, duration, when the option expires, and so on. But it's rather straightforward, but usually like the key point to understand that this is the agreement, you know. Both parties have to honor this agreement. So like, for example, you know, when we're talking about tech companies, especially in international companies, and you have option agreement, it's great. You know, I will feel that it's totally fine to have this kind of agreement. But for example, if you're doing private equity, you know, in smaller size, so you definitely should have some kind of collateral, you know, because not all parties like that usually honor this agreement. It's like sometimes they, you know, go to court and something. But, you know, this is not the case for the tech, I guess. It's not many examples of that, but just to understand you that this is the agreement, not a fact. I guess the key point is that usually employees, when get options, they have this cliff after first year. So the first year you don't get any options, any stocks vesting, and after the first year, depending on the contract which you have agreed on, so basically get the vesting on monthly, quarterly, yearly basis, whatever you decide. So that means after the first year, you get your stocks every month, every quarter, or every year, you know. So it depends how you agree with the company you're working for. So vesting concept is this, like vesting as a word, is this concept as you're getting from the agreement as an option, to your factual ownership, so that when the stock vests to the stock, so you get from the agreement between you and the company and the ownership, which is the fact. So this is like very important. And option by its definition, so it's you have a contract, and when the stock vests, it is owned by you. So, for example, if you have a contract for 4 years and you work only for 2, so remaining 2 years do not vest, and the stock is not. You don't get the remaining stock of the last 2 years. So it's this is, I guess, the key point, to understanding the techniques, working for the company. Now I'd like to cover, some more interesting topics from my experience and how things go from, how you feel, when you're working and you're getting the stock, and how it's different, than the simple employment. So essentially, this is kind of transformation of your mindset, going from the employee to shareholder to investor, and essentially, well, considering only like getting stock options, you have 3 major steps. So the first one is employee. It's very simple, straightforward. Basically, you sell your time and you get fixed amount of money. Extremely simple, but the key advantage is stability. A lot of people like it. Key advantage, you're never gonna be rich. So like it's basically impossible. Key objective of your work, make your task good as possible and get a better pay in the meantime. So, so it's like really straightforward, not much to discuss. The next step, basically you get some kind of stock options. You vest the stocks in the first, second year. You kind of start to be a minority shareholder at some point. But essentially, looking like from the structure point, you don't get any rights, to make any decisions. So basically, you have the same structure as employee. The only difference is that you potentially have this kind of call option, that if the company gets big, you can kind of get some paid. On the negative side, you have to think about it, like, is it worth a lot? Isn't like the company isn't performing good or not? And all this thinking actually costs you a lot because you allocate your time and resources and all this mental thing to this topic. So you have to basically to balance it, to understand where is the right place to be at this point. And moving forward, if you allocate a lot to your working career in the company, I guess you can get to executive team, executive board, working with a strategic team. And then it's a bit different because you make a strategic call. So, working as a board member and getting options is totally different because, your decisions are totally in line with your compensation and company value and your stock value. And the final step is definitely investor, which is like a final stage of the game. Because all you do is basically allocate capital. So you have your network, you allocate capital to try to reach your best outcome. So, so you make your money from your capital. So this is totally different. You don't have any relationship with your time. So it depends how good you're allocating your capital. And it's extremely complex thing because from my own experience, when you doing a lot of things. So whether you have a big team which requires a lot of capital, basically you invest millions, like tens of millions at least, or you have to do a lot of things by yourself, and that's quite difficult, just making all by yourself and at the same time. Interesting part is that your key objective is manage risk, So it's very different because you have a capital, you have to allocate it properly, meaning you don't have to have a drawdowns, which is, reducing value of your capital. So your goal objective, everything changes in this final step. And it's basically extremely hard to reach because you have to have like a lot of money to get there. I decided to introduce this one, because like I find it like very straightforward and easy to understand. And in case you get tired of waiting on minority shareholder return, so in case you basically decide to do your own stuff, to do your own project. So this is essentially Kiyosaki, Two Fathers. I guess you have read the book, the Rich Father and the Poor Dad, the Rich Dad, yeah. So basically the book. And it's a bit more adjusted by the fact that, have a little more steps in between. So essentially everyone starts as an employee. We tired to get the work done there and, all the routine there. So the next step is quite simple, go to self-employed status or to go as a business owner or startup owner. Two steps essentially here. So as a self-employed, you have to do everything yourself. You still sell your time, which is very limited capacity, so your earnings are very, very limited. But on the other hand, you have to do everything yourself, and there's a lot of things you have learned in between and in the process. And if you go from self-employed to business owner, startup owner, so you're basically getting from selling your time to making a system and earning money from that system. So it's definitely the more complex thing, and it's like super difficult to manage that. But if you manage that correctly and being successful at this point, so you can definitely earn a lot of capital, and you get as an investor at that point. So essentially this thing is, I guess, totally different than the previous slide because of the fact that it's longer way. So it's more difficult and it's more unstable way. Room of thumb from getting from employee to some kind of successful businessman, business owner, or I guess startup as well, is at least 5 years. From my clients who I work with, so the room of thumb is like 5 years from the point of view where you start, from basically nothing, and I call it 5 years when you like don't have to care about the money, make decent living, and have a lot of like cash to invest. A lot of like not millions, but you can definitely make investment decision at that point. So success cases, I guess, is 4 years at best, and usually it goes up to 7 years. So I'd call it like a longer way, but it works, and essentially the positivity of this, that you're making decisions in the process, and as well you're majority shareholder in the company that you have built, which is building your equity as a value of your business. So that's essentially the key flow of your net potentially. Usually when I think about the expectations about stock options, so I usually remember one guy. This is the Cho, the guy who painted the Facebook office back in 2005. And the story was that in 2012, when the Facebook got its IPO done, so the guy was worth like 200 million. And everyone was talking that he didn't accept it. He accepted not to take cash, and he accepted a stock and stock options, I guess, and he waited like this 7-8 years and got 2 million value of his net worth. So when you read this kind of headlines, you think that guy paints walls at startup and still a multimillionaire. I guess can be. I guess I can be as well. So it's a bit tricky, you know. So I guess he got the stocks back in 2005 when he was painting the first office, and Facebook was established in 2004 February. So basically, the company was totally new, with essentially no cash flow, and like Facebook is one of the success stories whatsoever of the last decade, and one of the most successful companies. And you know, you get in the right time, right place, and get absolutely crazy pay for that. And the other one, I guess he's more famous these days as Chamat, one of the early employees of the Facebook. So, you know, he's talking a lot of himself and his journey, you know, life journey, as he was born in Sri Lanka. He was flipping burgers and Burger King, and now flying private global 7,500. You know, and this is like the very end of the private jets. But essentially, the key point is that he started in the Facebook in 2005 and was working, I guess, until 2011, and that's quite especially a long time, as well as getting in the company at the very early stage. And you know, like considering what's on the internet and all the sources, so he's a billionaire now. But he, after exiting the Facebook, he was working a lot of, you know, venture capital and doing business with all Silicon Valley stars, including Peter Thiel. So you know, he basically exited this kind of doing business in the third quad, business owner, and entered into investor stage with the decent guys who know how to do the money, and reach this kind of billionaire status. So just to make, you know, it's easy to read the articles, you know, headlines, but it's very hard to do, you know, getting to the point where you are seriously rich, and it's definitely super hard. So I would say there is no like expectations should be at this point that, you know, if you get stock options, you can be like very easily 10 million, you know, worth by any soon time in the future, I guess. The most complex slide of the deck. So quickly, I found this thing on the top left corner interesting. You know, that the guy who's investing in the venture capital. So this, you know, basically emphasizing that how things are changing now, and essentially, you know, debating you're starting a company, you get 8 million valuations, and if Sequoia is in, so you get infinity. So I found it funny, you know, just start about valuation, but just understand how exactly valuation is working. So it's a bit difficult for the venture capital and startups, because it's very hard to, you know, to try to find exact figures in this space and try to find the value from the mathematical point. But on the bottom we have microeconomics perspective. So essentially you have like seed investments, and you don't have like working prototype, or you have just MVP. So you're just talking about your market size, team, its record, initial growth dynamics, and I guess at this stage you just try to find the more companies that are willing to invest and like create a competition, which one is like provides the best opportunities for you. So the second stage, when you get some kind of revenue, working product, so you can potentially find multiples on similar companies, you know, revenue, users, and of course replicating costs, which are usually at that point are quite significant. And like after 5 years, when you get big and growing fast, so execution is the key thing, you know, how the previous plan was executed and whether it was like targets and your KPIs were reached. Usually they try to talk about profitability, not always, but still it's on the table, and it is discussed. And at the final stage, you have, this concept of going public, doing your IPO. So, you have to prepare for that. You have to find like exact timing, which is good for your company to go on the market. So a lot of politics going in at this stage. Like you have to find a lot of moving parts in the right place to make a decision. And at that point, like multiples, revenue, earnings, I guess, discounted cash flow, if there is any, profit at that point, EBITDA or whatever, so you can discount that and like make a conservative guess for the company. So this is like mathematics going how to calculate the company, how to make your arguments for the value of the company. And usually if the company is growing, which is the case for most of the startups, so you can definitely get a higher valuation. And so basically the value is going up, which is like one of the key advantages of doing startup. But on the other hand, the growing expectations from the shareholders as well as yourself as a small stock owner. So you have to understand and you have expectations basically how fast you can go, how fast your value can go your equity value can go. And major factors that affect this is the macroeconomics, how the market is feeling at that time, because basically you go to the investors and tell them the number like you're willing to get for your valuation, and then they tell you a different number, whatever they think, and usually that number from the investor is usually like coming from some kind of market perspective. So macroeconomics is like what exactly economy is doing and how the stock market is doing, and basically all that transmits to something called risk appetite, how exactly they feel about the market and willing to take risk to get you some high valuation at this point. So just to clarify my view on this, because like macro is like super complicated stuff, but essentially what I'm trying to say that when the company goes public, it's different game, When the startup is private, so all the investors are trying to push the company value higher, and the incentives from all the stakeholders are basically the same, Everyone is trying to go higher, reach IPO point, and make a, exit investment. When you do that, when you go public, basically company can go long and short. As an investor, I can basically buy it and go long, and I can short it and go, basically earn from the stock value going down. So that's completely different field, And my point is that, I just Googled for the biggest IPOs of tech IPOs in 2021, and like just the biggest one, that were made in the very end of the year. So just the market is going down, and all the companies are going down, and this translates to the lower valuations which are coming to the startup community, and this is a good example where a lot of people are talking that, for example, Tiger Management, which is one of the bigger players in the field, I guess recently closed their largest fund, which is like $12-13 billion, and one of the things that guys are discussing that the fund is like making one investment every day. So every day they're making new investments. So they make like 350 investments, and basically everything is automated. So you get data from the stock market, you get data from all the data sources, and you can provide your offer for the new valuation like in 2-3 days, which is the key point from value point from Tiger, So this is interesting because like this market is getting so big and it's getting so large by its valuations, and the capital working in the market, that you have to automate all the investments. And when you automate, you basically attach yourself to the sentiment of the stock market. And if the stock market goes like 50% down, and Nasdaq is, for example, 20% down now, but if you eliminate all the big caps, large caps, so all the remaining high growth, low profitability companies, tech companies are down like 50, 60, 70%. And all this data is linked to the valuation models. And I guess that this tendency is not going anywhere, and things might get even more interconnected between stock market valuations and getting your the number for your company and the value of it. So I guess it's gonna be more volatile in the future than it was before. All right, and the couple of things from my own experience, So owning equity in the private company is rather tricky. First of all, it's not liquid. You can basically cash it only in the funding round. So it's definitely not a stock. For example, if you buy Apple, you can drop it anytime. So equity investment in the startup is illiquid. And there are some times when you have 2 years window when you cannot sell it. And all this illiquidity aspect attaches to the relationship with the company. You're actually always thinking what you can do in terms of this relationship. The other thing is that things happen slowly and then start to move exponentially. So this is the idea I mentioned before, when you start do something, it's like super slow, and it feels like nothing is working, and it's going so slowly. But like after 2 or 3 years, it starts to grow fast, and then you get exponential if you do things correctly. And from my experience, from my social circle, so it doesn't matter what exactly you're doing, but just you have to. The key point that matters is essentially is the right asset. If you're investing, is the right trend. If you're trying to find a business fair. Your team, people, mindset, work ethics, and all these things basically compound by each year and grow together with your value of stock. So I would say that stock options are great because the companies are basically sharing the value they create with the community, with the workers, which was not the case in the past. Now this thing is changing, which is amazing. This is essentially a great thing. But my point is that you have to, find this chemistry between the management team, the company working, and essentially all the things I mentioned here, just to find the right fit. That will enjoy working there for 5, 7, 10 years, which will be required runaway period of time. Couple more when you get decent equity value in the company. So equity which you have in the company is an investment, and it should be the part of your investment portfolio. So if your equity stake in the company is too big as a share of your net worth, so it's hard not to overthink about it. So for example, if you have a million net worth and your stock options and not stock in the company is 900,000, so it's definitely too big. You are dependable on that number and that company and that strategic decisions, and I guess that number should go down dramatically, to 50-40%, just to be cool, if the things go bad or whatever, but the remaining 50% can provide you passive income, and you're gonna do just fine. So, this bullet point provides you some kind of, you don't stress about that, and it's very important when you go to big numbers. It's important. And the final one, you can't earn all the money in the world. So basically, if the value of your stock in the company is going up, so I guess the right thing to do is like sell your stock incrementally. So every round you can sell like 5, 10, 15, 20% down, and it's totally fine, because if the things go right what you exactly expect, so remaining part will be definitely more valuable than the part you have invested. But the part that you divested, you can invest in real estate, investment funds, whatever, like a lot of assets, and they generate a return as well. You have to just diversify it by assets, risk, volatility, geography, and whatever. And but that provides you like a diversified portfolio with stable income, and but still you have this kind of option which is in the company which is growing fast, and you have this like best potential return of your net worth. So just to tell you how it could possibly be done. And I guess the final thing is that at the end of the day you have to be like happy. Whatever you do, doesn't matter how much money you have or what is your net worth. The key thing is to be happy. Because at the end of the day you have so much stress and think about everything. And one of the topics of my friends today is like it's going too fast and too many things. And when you hit 30s, so things mentally and health-wise getting a bit more different than it was like when you are 24, 25, working all day, all night, whatever. And then when you're like 30, 35, it's like different. So, it's not about the money all the time. You just have to be happy, and get through things in a decent amount of time. All right, thanks a lot. Sorry for being so long.
All right, thank you. If you have questions, please raise your hand. One quick question. I'm also checking YouTube, so if you have a question on YouTube, please write it in the chat. So one question from a bit of personal side. What made you go into investing?
I don't know. I just always liked the numbers, and going through the life, I guess it's even more better because essentially all of the answers are some kind of in the form of figures, numbers and figures, and you can find all of that in the data stream, which provides you as a company, as the personal finance, whatever. So everything is in numbers, and that's amazing, I guess.
All right, and we have question.
Yeah. Is there any rules, especially in early stage companies, when you find some nice guys that you want to actually do business, do you have any rules to how you should make an options for them?
So usually you have like 10-15% of the stock allocated for the employee options. So essentially from all the stock you have, 10% goes to employee. And from that pool, you have allocate some kind of percentage to the employee. And depends how many employees you think to hire, and you basically allocate that number to the employee. So it's a simple game, allocating proportions pro rata.
And thank you. And we have one final question here.
Just a quick one. So what would be the better option, to have 1% in $1 million worth of startup, or have a 0.000 something 1% in $1 billion startup? Thank you.
It's hard to say. I haven't run the numbers for this case. You can make a simple Excel calculation at this point, but I guess the key answer here is that at the $1 million company have definitely higher upside, I guess. But I guess I should go and check the Excel, because like as I mentioned before, all the answers are in the figures. You just have to make a lot of scenarios, know how things go, try to double check with the data, back test it, and you can find it all there.
All right, thank you.
All right, thanks a lot.
And now we switch to a speaker who's joining us remotely. Welcome, Kaspars.
Hi, everyone. I hope you can hear me well.
Yes, we can.
Okay, great, amazing. So thank you for having me here. So bit of an introduction. I work for the Printify, a print-on-demand company, legally a US Delaware corporation, but headquartered and operating mostly from Riga, Latvia. I myself, by trade, am a lawyer. So I deal with all things legal within the company. Printify is a sort of very diverse company. We have 600 plus employees. I think it's now even more than 650 employees, and our staff is all over the world. We embrace the remote first approach, and we have people working here locally in Riga, but I would think to say that actually most of our employees do work remotely all over the world, mostly from Europe because of the time differences, but still. We operate in the print-on-demand market, which we consider to be worth about 30 billion, and it is growing constantly, and it's growing pretty fast. So that is the context of Printify: growing market, growing company, fierce competition. So we are always competing with our competitors, not only in terms of financial goals, market shares, but also in acquiring the best talent, because in the end, it's the people that decide everything. So we see it as a very important aspect to Printify, and that's why stock options are an integral part of this strategy. So I will tell you a bit how we do stock options in Printify, what have been some of our challenges, what have been some of our conclusions, and also a couple of things that you should remember. So mostly what I will tell you will be from the perspective of a company, not the perspective of an employee, but I will also try to cover that part. But again, this is mostly addressed to those of you that in the future will be managers, founders of startups, and will operate like that. Actually, I'm really glad about the great presentation given by Skirmantas. He already touched a couple of concepts, the keywords: cliff, vesting, options, grants, exercise price. Those are the terms that I will also use in my presentation. So without further ado, first of all, how we do stock options at Printify. First and foremost, it's important to say that almost all employees in Printify receive stock options. It's only the merchant support agents, the people that communicate directly with our clients, that don't receive stock options, but anyone above that role receives stock options. And if people are promoted from a role where they don't receive stock options, they do get stock options about promotions. So I would dare to say that Printify is one of the sort of most generous companies, at least definitely in Latvia, meaning that it's not only the top management that receive stock options, it's a whole bunch of employees. Actually, most of our employees do receive stock options. The stock option amount that each employee receives is tied to the salary. It really depends on net and gross amounts that the employee receives. And here we have to actually calculate how many stock options to give to each employee. We could, of course, consider the current value of the company, but definitely we are, well, not really a startup anymore. We call ourselves a scale-up. We still have very ambitious growth targets. So we have to look further down our road what will be our value in, say, 4, 5, 6 years. And we have a calculation where we estimate or sort of predict how much Printify will be worth in future in 4, 5, 6 years. And based on that valuation, we calculate how much employee stock options will be worth after the vesting, and our vesting term is 4 years, so we'll speak about a bit later. And based on that figure, we calculate the amount of stock options versus the total salary that the employee will receive in those 4 years. And depending on roles, there's a different percentage. So there could be a role, for example, where the amount of stock options granted will be equal in 4 years. The value of the stock options granted will be equal after 4 years to the salary that the employee has received in those 4 years. So another 4-year salary at the end, of course, provided that the growth targets are achieved and the company actually exceeds to that valuation. Another very important principle in Printify is that employees are always vested. Skirmantas already touched upon this. When an employee receives a stock options, it's a contract. So you can't, as an employee, immediately exercise those options, meaning turn them into actual stocks. They have to vest. And in order to motivate our employees to be interested in growth, there is this golden principle that employees are always vesting. If, for example, and we have early employees where their initial vesting term has already passed, meaning that they can actually or could in past and actually did exercise their options and became actual stockholders of the company, they have received additional grants, because we feel that this is very important part of as a motivational tool for our employees, give them a sense of ownership, first of all, and second of all, also motivate them to actually work hard for the company to achieve growth targets. So already spoke about vesting. What are our vesting terms? So vesting of our options are based both on time and results, meaning that 60% of particular employees grant vests within 4 years with a 1-year cliff. As Skirmantas already said, 1 year is a period you have to work for Printify. Then you get 25% of stock options. Thereafter, it's monthly vesting. So each month you work for the Printify increases your amount of vested stock options. The remaining 40%, they are tied to company results, and the golden metric that we in Printify live by is called GMV, gross merchandise volume. So upon company achieving certain milestones for a whole bunch of employees, additional bunch of stock options vest. So this is how we do it. There's a bit of a lag. So yeah, still, there are plenty of things that we see that we can and we actually will improve. So here, what we want to do, what we want to achieve considering stock options. So first and foremost is that we are always working on a comprehensive remuneration system with stock options as an integral part of it. People these days are not only interested in how much they will earn, what will be the benefits, will I get free coffee in the office? People are actually right now interested in, will I receive stock options? What do I have to do to earn more stock options? If I will do that, will you give me stock options? Can part of my salary be paid in stock options? So these are very important questions, and each company deals with them differently. And I feel personally that in Printify, we are actually at the beginning of this journey, and we are constantly working on this comprehensive system. I cannot really tell you what it will be like in 4 or 3 years because it changes constantly, but definitely that's something that is always on our mind, on both for leadership and people actually working on that. We do want to implement a cap table management software. What it means that for a company like ours, which is a US company where we have many stockholders, we actually have to have a central ledger, a big Excel table, if you would, where each and every stock option holder is listed, every shareholder is listed, every investor is listed. So that's not complicated if you have 4 shareholders, 10 shareholders, 100. Beyond that, it becomes a complicated affair. And there are special software tools like Shareworks that actually automate this system. And we see that this is something that we will need to do. And why I'm telling you this, especially considering that there may be future founders among you, this is something you can actually think about once your company gets going. And especially after initial Series seed rounds or Series A rounds, that's something you will have to consider and think about. It is important that there are robust internal procedures to sort of giving stock options, because granting stock options and managing them is a bit of a complex affair. And it takes time, it takes human resources, it takes involvement of finance people that do calculation, actual managers of people who have a say in how much, in question like how much an employee will receive in stock options. It takes HR to manage all that, and of course takes certain involvement of legal function. Do we have proper paperwork? Have the board approved grants? Have they approved it in a correct way? So things like that. It is a bit surprising how that can become complex. So we definitely see that robust internal procedures are very important, and that's something we are constantly working to improve. Also, a very, 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 and it might actually be the most important aspect from this slide is that we always have to work on employee engagement. What does it mean? On the paper, it all sounds really nice and good. You, my dear employee, have received stock options. You are now part owner of the company. And it could work like that in countries where we have an established startup culture, where people have previous experience with options, stock markets, things like that. But in reality, especially in Latvia, there aren't that many startups that have given out stock options. So people they just simply don't know. Some of the terms that we use, like vesting cliff, grants, they hear them first time. And again, what's the essential point of giving stock options to employees? It's to actually give them the sense of ownership, to get their sort of motivational investment in the company, an emotional attachment, if you would. That's also a part of it. So it does not work like that if your employees don't really know what stock options are. And that's something we in Printify see as a challenge, and we will definitely work on that, like visual tools, like booklets, internal videos, presentations, explaining. I would love to see in Printify that we would have a certain digital environment where an employee could actually go, say, to a website and see how many stock options they own, how many have vested, what will happen after certain years. So this, in my opinion, is really, really important. I mostly focus on paperwork, but this is something that I have discovered. And here, there are plenty of technical tools. I already mentioned cap table management tools. Shareworks are the most famous of them. They can actually help in that because they do create these digital environments like websites where employees do have their individual profiles, like workspaces where they can actually see what's their stockholding status. And I trust that this is something as a pleasant experience. One could go to the website and see, okay, cool, I do own that amount of the company, even if it is in the form of stock options. So I think it's really important. So what have we learned so far? So Printify has been giving out stock options for quite a while now. I think our stock option plan was issued in 2016. So it's been a bit of a history right now, and we have learned something about stock options. So first and foremost is have a stock option plan. In any jurisdiction that you work in, and as I said, Printify is legally a US company, a Delaware corporation. Your companies might be in different jurisdictions, but in all jurisdictions I have encountered, in my experience, everything starts with the stock option plan, meaning how many stock options are reserved. 10-15% from the equity is pretty much a standard, can be lower, can be higher. And this is all written down in your stock option plan. You have to have like a game plan, vesting terms, basically anything that you think it's important. It will be your rule book, how you will play by in this stock option play. It might be overwhelming, especially in jurisdictions like US. You can't imagine the size of legal paperwork in the United States. I think our stock option plan is like 30-something pages long, and it has addendums, 30-40 pages long. It might be overwhelming, but don't be afraid. Companies have done it before. They have done it successfully. There probably is a standard template that you can use. If you can't get it for free, well, this is time to invest a bit in your consultants and actually have their advice. So have a good stock option plan once you decide to give stock options. Standardize the processes. I mean, it was a huge challenge for Printify once we had this explosive growth in employee numbers to actually implement coherent procedures of giving out stock options, because it's not just like, okay, you have stock options. It takes certain paperwork and questions start to pile up. I was promised this, now we want to give that. You have to deal with all those aspects. So standardize as much as possible. Prepare template samples, have dedicated employees, have IT tools. This helps really, really a lot. Again, educate your employees. I cannot stress this enough. Explain to your people what are stock options, what will be the benefit they will receive them. Tell those stories about that painter that received this huge value, as Skirmantas told the story. Stories like that inspire employees. So do that, do educate them, explain to them what are their limitations. Don't hold back on saying that stock options are like this huge value already. No. The company needs to grow. The company needs to get to IPO. Then you will get your millions. And this is also part of why our founders actually founded Printify, because we want to build a startup culture out of Printify, like it happened with Skype in Estonia. We have also this dream that Printify will generate not only a huge load of money for its founders, but there will be plenty of money for our employees, for our option holders, currently option holders and future stockholders, so that they actually become investors, become founders, so that they have money. So this is important to us, and I think it's really important to share that human perspective also to your employees. Use it as a recruitment tool, especially if you are a sort of early stage startup. You really can't afford to have top level talent, but you can attract them with stock options. People could actually agree to work for you for a lower salary, or a salary that they wouldn't accept if you give them stock options, if they see upside in your company and see future potential growth. You may want to hire, I don't know, a software engineer with a standard of 6-figure salary per year, but you may hire him or her on a salary that you actually can afford by offering a meaningful stake in the company in the form of stock options. So that's something we do use a lot, and that's why we do advertise, and that's why we are really proud that we do give stock options, and we are really proud that actually most of our employees receive those stock options. And finally, the last but not least, a very important aspect. Be mindful of tax regulations. Why it is important? Because in many jurisdictions, stock options have preferential tax treatment. For example, in Latvia, upon fulfilling certain conditions, you don't have to pay income tax and social security contributions when you give stock options to your employees. They are rather taxed as under capital gains tax at the moment when employees actually liquidate or sell those stock options. And that rate of capital gains tax, I believe it's 20% versus almost 50% effective rate for standard salary. And you'd be surprised how this differs from country to country. And interestingly enough, our investor, the Index Capital venture fund that has invested in Printify, they have this survey of the best regulations or places with the best regulations from stock markets, and guess which 3 countries are in the top 3 spots? It's Latvia, Lithuania, Estonia. So we really have a huge, we can really benefit from those regulations, and we can do almost anything within reason and actually exploit the very, very preferential sort of legal environment that we have. So be mindful about that. Make sure that your employees are taxed as little as possible so that they receive as much wealth as possible out of it. So I think my time is up. I'm really eager to hear your questions. So please feel free to ask anything. And yeah, I'll be happy to answer.
Thank you, Kaspars. And we do have a couple of questions already on YouTube. So one of them is, do you think it's viable to ask for equity for consultations, part-time work from Baltic startups?
From my experience, yes. There are consultants that are being paid in stock options. So I would say, yes, it is viable.
And then the next question we have is a person asking, I saw statistics that only 15% of companies that have successful Series A financing ever reach exit events. What signs to look for in a company before joining to increase likelihood to cash out?
Oh, well, that's a good question for those people that actually deal with figures. I don't deal with those, but I still am a big believer that you have to actually look at the financials. I personally would look at the size of the market, what sort of unique things the company has. But in all honesty, I'm not the best guy with numbers, but I would definitely look at the people, because again, it's the people. The managers, the founders, how passionate they are, how smart they are, and I would personally look at those. And if I think those people are like really hard-driven, smart, and have certain previous experience, that would definitely increase my chances of actually accepting. Well, considering that this company will grow further.
All right. Do you have any more questions here in the audience? No more questions. So again, thank you, Kaspars.
Thank you.
And then we go to our first speaker back here in person, Elvinas. Welcome.
Hi, everyone. Oh, I can hear myself so loud. Okay, employee stock options. I call the presentation Many Sides of the Coin. We spoke briefly with Mindaugas. He said that share your own story, don't do like a lesson for others. And you've heard the theory, so I'll just share my story. I've tried rehearsing it twice. One time I ended up doing it in 10 minutes, another time in 33. So I don't know where I'll end up, we'll see. So let's go. So then in 1 minute about me, and this is only important because when I say in the past or in the previous company, you get to know what I'm speaking about. So I've started in a company called Barclays, actually. They're a technology center in Lithuania. and then moved on to work in another bank, a Danish bank this time, also their technology center in Lithuania. And now I am an engineering manager here at Vinted. Why is this important? This is important because in both the banks, the bonus, what's paid on top of salary, is paid in cash. I added an asterisk there, at least for mortal people, because maybe the people in the boards and the very senior people got the stocks as well. Now, here at Vinted, we get the bonus only in stocks. So when I say now or previous company, you get to know what I'm speaking about. Good, moving on. I have a question for the audience. Can you raise the hands if you know this term, an anthology film? What does that mean? Mindaugas saw the slides, so that's one. Okay, nobody knows. I didn't know it either, my wife helped me with this one, but basically an anthology film is a film, a lot of words, which is basically consisting of several shorter films that are tied together by a single theme, premise, author, or something, but they are not like one set of movies. So you could imagine some movies where people speak in cafes and different people appear and have different conversations. Why am I saying this? Because this relates to the title of the presentation, many sides of the coin. So I'll speak about stock options from my own perspective as an employee, from my perspective as a manager, and then my thoughts on how does this help with overall talent and performance management in organization. So we'll be having some perspectives. Good. So yeah, as I told, we'll have employee, we'll have manager, we'll have employee stock options as a tool for talent and performance management, and then, yeah, let's begin. So for me as an employee, a few points here. First of all, for me personally, it shows like the position of the company towards its employees. Does the company give the stocks to everyone in the company, only some people in the company, like only sales, only engineering, or anything else? And for me, it already tells a lot more about company's culture than the values page on its side. The other thing, it does create a commitment for at least 12 months. And afterwards, there is no waiting for April. Now, why I mention April? For those of you that worked in corporate, usually you get your performance evaluation at the end of year. Then at the start of next year, usually March or April, you get your bonus in cash. So if you check the distribution of leavers in the company, nobody leaves in December or January if they got a good evaluation, because this is a time to wait for your bonus to come. Obviously, you don't leave in February or March unless you got like a significant better contract. And then after April 1st, the hiring market begins. So before summer, you find a new job and you're likely to get your bonus next round. So this is how corporate works, at least the two banks I've seen and some other banks I know people are working in. Now with stock options, if the vesting goes that, let's say you get the cliff period is after a year, and then it's every month, you're free to leave every month. You don't need to wait for another month, because basically that's your cycles when your leaving is cheaper for yourself. So yeah. And a lot of the things I'll say today, they're neither good or bad. They're just my insights. You can like them, you can not like them. We'll have the question section for that. So before having employee stock options, it was never like on my radar. I didn't even consider this being a thing, because in the bank you don't get it, so you don't consider it so much. Now it is already on my wish list from another potential employee, and not only because of the stories of like the Facebook story of this painter guy and all these magical stories, but even here at Vinted, what you could call as a reasonably fast-growing startup. The last couple of years, I believe Vinted's value was almost, like doubling every year. Printify is growing fairly fast, and then you recognize that you actually get the benefit from, being here for a longer time, and especially if it's a startup, then you speak about stock options. Us in IT market, the engineers get offers more frequently, the managers get offers from LinkedIn a little less, but they are happy once they do. So the last offer I got to like leave Vinted and join another company was also from the startup. And one of my questions, like in the first 5 questions was like, do you give stock options? Yes, we do. How many? Then they say the number, then I say too little. So, and that's life. Because they're on very early startup, they should be giving, more. And some parts of the strategy become more important. So I know employees that don't care how the company is doing, especially if you only get the salary, you don't care so much as long as your salary is there. I know people, at least myself, are more interested in strategy, but the thing like, are we planning to do an IPO becomes important only if you can benefit from it. If not, if you're only getting the salary, you don't really care if we're doing the IPO or not, aside from all the compliance work that's related with preparing for the IPO. And I guess the other part, at least for me, and I'll later speak about being a manager because the people in my team also verify this, when you become an investor or close to an investor in a company, when you have stock options, as Skirmantas told, you start thinking about the company. And if it's growing, it's nice. But what if it's not growing anymore or it's actually reducing in value? So basically a part of your compensation is getting lower every month. And this is when you start really minding, the strategy of the company and is it going in the right direction. And for now, I've been in Vinted for a bit more than half a year, so I'm still in the middle of my cliff period. So for now, it's still like a second or third pillar of pension. There's some money being allocated somewhere, but I cannot like really touch it. So that the only difference is that there's a chance that I'll get this money sooner than the second or third pillar pension. So that's perspective as an employee. Now, if we move to perspective as a manager, I have a phrase before that. So some colleagues, some people in my team including, they're calling stock options monopoly money or lottery tickets. Maybe some of you that work in startups recognize these phrases, but it changes once it's become real. And I'll tell the story in the middle of next slide. So me as a manager, the Kaspars mentioned that it helps with the hiring, and I can only partly agree because the engineering market is so hot right now. Everybody is trying to figure out ways of how to attract those people, and every single engineer has at least several offers on the table if they open the LinkedIn messages page. And employee stock options help is, in my mind, the animation didn't work, limited. What I mean by limited is that I don't have the precise math, but if we could take 20 interviews that I had, out of 20 interviews, maybe 2 people have inquired about the stock options, like what's the size of the package and then what's the vesting period and all these things. For others, they saw it on the page that we give something, but they were more attracted towards the company because of the culture, because of the name and the brand we have here in Lithuania and all other things, not because the stock options is listed on the page. Then after hiring with the people, we move on to start working with the people. And for new people in my team, at least I spoke with them, and it seems that stock options have no real effect. It didn't affect their decision to join or not join Vinted, and until they have the cliff period, they don't feel that this is something real. Something is ticking, second pillar pension again. But for people that I call old money, that are 5 years and more in Vinted, majority of our one-to-ones, so of our meetings person to person, become company strategy discussions. I have one employee in my team, and we never speak with him about him, his performance. We're always speaking big picture Vinted, investment to that site, investment to another site, is this the right move or a bad move, what are we doing here, etc. And like after 5 talks like this, I enjoy these talks, but I have my role as a manager, I need to talk with certain things with the people. I asked him, why are we speaking these things? Like why every talk is like strategy? And he told me, because I'm an investor, and this lottery ticket is now real for me. Like it's important to understand, are we going in the right direction, because it will change my decisions related to it. And yeah, then I started getting it. For me, it's a bit different still. So the other is, I've asked the guys in my team and guys and girls in my team, would they change the amount they get in stocks to cash? Nobody said yes. So basically, no, and they value stocks more than cash. But there's a caveat. I'll come to that a little later. This is the caveat. So I've spoken with one person in the organization, and basically the ask or the request was, can we get a larger portion of the total compensation as stocks? Because, and I quote, other companies in the US are doing it. And then we started speaking, okay, differences between US companies and Europe's companies, super large startups like Uber and stuff, and medium scale startups, and all these things. And I believe that, I'm both believer in people and numbers, but we were speaking with Skirmantas, I Googled just now. So the stats show that 90% of startups fail. Some percent of them fail in the first 3 years, then later in 5 years, 7 years, and 10 years. So then if you start a startup that has a 90% chance of failing within the next 10 years, and you give a large portion of compensation as equity, so most likely in 9 cases out of 10, this person will get less than they would be getting in cash. But when people make this request, they typically rely on only the success stories. And since Vinted's position and some other companies' position is also paying stocks to everyone, then it's easy to get very different stories. Because for an engineer, with the market that we have right now, the salaries that we have right now, I could easily imagine like 30% of the salary being converted to stocks. His or her life wouldn't suffer. I mean, they could rent the same apartment, drive the same car, and go on vacation to the same place. If we take a person in another role, maybe an also more junior person, if you change 30% of this person's salary to stock, this person might have a more challenging time meeting ends in real life. And then when you make decisions as a company, you need to consider all kinds of employees and all kinds of roles, not only the engineering or maybe more higher paid roles that would like to get more stocks because they can basically allow themselves. And yeah, saying goodbye. Something I noticed as a manager, not like directly with my reports, but with speaking with some people in startups that have 12 months cliff period, is something I could call the 8-month trap. So basically, the first 3 months in the company, you're trying to understand what your role is. Sometimes that extends to 6 months until you get into the team, you become fully like functioning and become being useful to the team. And it's possible that by this time you recognize that it's not working for you. You're in the wrong company, wrong role, wrong team, or whatever. And you start, considering, is it time to leave or not? But you're already at around 8 months in your career, and it's only 4 months to wait before you unlock the first package. And there you go into a trap. And I've spoken to some people in this trap that, should they do what they want right now? Or should they stay, and because maybe when I get the stock options, they'll grow a bit, I'll trade them, I'll buy a new car. All these things. And I think this is a tricky thing. I completely get why we need the cliff period, but at the same time, every decision on Earth comes with its own risks or problems. And I think this trap exists. I don't have the stats, but as managers, I think we should really be really closely monitoring people between half a year in the company and like 1 year, 1 month in the company. So when they really feel that this cliff period is coming. Okay, and then my last perspective, employee stock options as a tool for talent and performance management. And this will be a little wider because this will cover overall compensation and benefits, you could say fundamentals. So I'll only like cut a portion of the whole theory. It could be way wider than that, but let's try to look at it. So I think one option what you could do with your company is create a start culture. How you create a star culture, it's really easy. You evaluate everyone's performance in numbers. I was evaluated in the scales like from 1 to 4, from 1 to 5, and the last scale was from 1 to 200, which is like a bit complex scale. But anyway, then you get a high evaluation, as mentioned, in December, and then based on several factors, company's performance, your own performance, and how much did the board decide to allocate to bonuses this year. The managers of departments, like VPs and sometimes below, they get a budget that they allocate to their employees, and usually they start with the ones on the list that have the higher rating. So it's pretty simple Excel exercise. This is how you create a star culture. So the positive side to that, because it motivates you to do the extra mile and maybe do it several times. You know, work on the weekend, sit at night, deliver a project, go outside your comfort zone, etc. But the negative side to it, that you mostly work in sprints. It's not like marathon kind of thing. It's not long run thing. And again, there will always be stars, and there will be average performance. And if at some year company gets a little less money for bonus rounds, the average performance will be considered like no bonus. And then, you know, average performers is, by average I call it good, stable execution. Is what your company stands on. The superstars are like one time and sometimes a bit show-offs, but the average performers is like the core of your organization. And then there is the other compensation method, is that you do something that they call consistent delivery, for the lack of better word. So you evaluate people in their role. So each role has, of course, its own salary grade from A to B, the range, and then you compensate for the responsibility of that role, and everyone in that role gets the same, like the salary within the same range and the same amount of stocks. So if you're a senior engineer, you'll be evaluated the same way all other senior engineers are evaluated. This creates fairness. This doesn't encourage like to fight each other or to prove that you're better than someone else. To get more, you need to consistently go into another level and start delivering more than senior, then you'll be promoted, and then you can get more money, more stocks, basically a higher compensation. The risk to this, or the thing to watch out for the managers, is to consistently check if we're setting the bar high enough. Because if everyone's compensated equally, let's say you become a senior and you continue being compensated the same way all other seniors, we need to constantly check if the bar is high enough, like what we expect from your delivery. Otherwise, we could end up in a bit like calm place where you deliver what's expected, maybe a little less, but nothing happens with that. You're still kind of compensated in the same way. So, yeah, in this slide, this summary with a question mark, because, again, this was an anthology film, so anthology films doesn't have a summary because it's different stories. So, last couple of thoughts. First of all, I think, and this is a bit what Skirmantas has talked about, that employee stock options, at the end of the day, they end up being stocks, and this is like any other investment. The higher the risk, the higher the reward. And this is something I was speaking with some team members about, that if you want stocks that are likely to grow very fast, you need to go into the companies where you're likely not to get the salary the next month. Because if you join the company of 20 people and there is a high risk you'll go bankrupt the next month or the next year, then of course your stocks are likely to grow very fast. If you join a like 500 or 1,000 employees company with a history of delivery and execution, most likely it's not gonna like hoop through evaluations. Like it's not going to be tens of times bigger than it was the year before. But you know that you will be getting your salary, your PC will work, your manager will be, a reasonable person, hopefully, and all these things. So the higher the risk, the higher the reward. Another thing, what I notice in the market, and I guess this proves by us being here, is that this is a really buzz thing in the market. And I think the early adopters will benefit the most because I've heard many stories of startups in Lithuania and sites of foreign companies of Lithuania where employees are pushing to get the stock options, and they're showing Vinted or other companies that have these as example that why don't we get this as they get this. So the early adopters of any large market trends benefit the most. And yeah, even though I've been in Vinted for a bit more than half a year, I already received questions from my friends that started pushing their own companies to implement stock options on how stock options work, because suddenly I'm an expert. Which relates to this one, don't be an employee stock option specialist. What I mean by that, like keep an open mind. And the funny story is that a close relative of mine who has for all his life worked only in government organizations, so had no stock options. I was driving in a car and having a chat, and he started asking, do I get stock options in Vinted? And I told yes. And then he started lecturing me of why this is bad. And this is bad because you get biased towards your own company. So like other companies in your portfolio, you're likely to review with more kind of care. But since you work here, you're biased, so you shouldn't trust the stock options, all these things. And this kind of showed me that suddenly everybody has an opinion on things they may not even have touched, maybe. So what I'm saying is that let's keep an open mind. The Western market and the United States has definitely moved to giving a way larger portion of the compensation as stock options. Here in Europe, we're always like catching up, but I'm not really sure if that's in the end going to be the right way or they will change the opinion again. So what I'm saying is that it's nice to have these kinds of discussions, have different perspectives, and yeah, thank you. Stocks only go up.
Thank you. And now it's the time for questions. If you have a question, please raise your hand. We already have one question in the YouTube chat, and the question is, Elvinas, startups always complain about the lack of talent, but there are more than 4,000 people working at Danske, SEB, Swedbank. If all of them knew about stock options, do you think the talent problem of the startups would be solved?
Well, they know it already. It's public on the ad, so no.
All right. Do we have any more questions in the audience? No questions? Then thank you again. And now let's go to our final speaker, and that's Simonas.
Oh, that's all right. How does this work? All right. So hi. This is me. I'm an interactive developer, which means I've been doing software that is interactive. I've been doing this for like 10 years now. Started with Flash, moved on to JavaScript, did some Node, did some React, worked at these companies. Some of you might know some of them. And I'm here to talk about stonks. So when Mindaugas actually texted me and said, hey, do you want to come and talk about equity? Because I've heard you have some stories to tell. I tried to piece like what stories he was probably talking about. And what I realized was that it was probably this one thing that we had at my previous gig. So back when Corona hit, and this is now probably demonetized on YouTube. So back when Corona hit, and we had this spike in company evaluation in like a software sector, we had this inside joke, basically this meme. Since I quit a few companies before the whole stock option or RSU grant vested for me, we had this joke where we would count how much money theoretically I lost because of those decisions. And at the very peak, it amounted to 650K. So this equates to about 22 yachts that look like this. And that got me sort of thinking about stock options and RSUs and basically stock grants in a new light, because before I just sort of figured, hey, that's something that I get extra, and I didn't really think what that entails. Another thing is that I started going to interviews, basically to job interviews, because I understood that this is a skill as any other skills, and I don't have a lot like proficiency in it. So I started asking people and asking companies what stock options, what stock programs they have. And what I realized is that there's not a lot of companies that do have some programs. And so I think we need to talk more about stock options. And so this is my working cynic's guide to stock options, basically. This slide is funny because I should be talking about like the general gist of what it is, but I'll save you the details because there was plenty of talk about that already. I think that stock option and RSU grants, basically any share grants, is a very good way of incentivizing employees, having them attached, kind of keeping them and all that stuff. And usually you get something, like 3 or 4 years with 1 year vesting cliff. That means you get, say, 25% the first year, and then whatever, monthly, quarterly, or yearly. So what I've came to sort of come in contact with was RSUs or stock options. RSUs are basically shares in my mind. There could be different specifications on how they relate, but back when I got them, one RSU was basically worth one share. So the thing that I came to realize, and this is just from my experience, you could expect your 1 year gross salary in the whole sort of 3-4 years period. And that goes to pro tip number 1, which is you should do away with like thinking netto money per month and start thinking in like yearly numbers. So let's say you want to earn 90K a year, you get a 72K a year salary offer, and then 60K of RSUs over 4 years. That amounts to 87K. The math is right, by the way. I checked it 20 times, I think. So this is pretty close, right? If it turns out that it's not close, then you can negotiate. And pro tip number 2, from what I've learned, is it's kind of easier, and I think it was sort of approved. It's kind of easier to negotiate for more stock than for currency, salary. And so this is like a pros and cons thing. You can do short term and focus more on getting money now, or you can do and try to get more stocks or options. I'm not here to give you financial advice, but everything kind of follows. You want to diversify your portfolio, read all the stuff that smart numbers people tell you. So, just do that. Now, when it comes to stock options, it's really interesting because it's the thing that you get an option, an opportunity to at some point in time buy those options. It's kind of like it's really interesting and really different from the RSU thing or any like share that has a certain value bound to it. So you never know what stock options will be worth after like 3 or 4 years. So it's always a gamble. But it's a long-term investment, basically. You're projecting, if it works out, I'm going to get tons of money, basically. And here I have another example that kind of, in terms of how I try to think about stock options, is if you get offered, because most of the times you either get offered a percentage or a fixed amount. So say you get offered a 20K stock options that has a strike price of $1 for just easy to understand numbers, and the company exits for 100 million. So now, what is your share of shares worth? Well, you have to know what was the total amount of equity. And so if it was that there was like about 20 million of stock units, then it turns out you stand to gain 80K USD. It's pretty good, right? And that amounts to 0.001% of total equity. And it's interesting because then you can start to think in terms of percentages. So this I took from the internet as basically everything. I don't really know what I'm talking about, but you can sort of get a quick glimpse of what you can get, what you can expect in joining early. From my understanding and what I came to understand and talk to people, 0.1% is good, 0.2 is great. Everything beyond that is astronomical in terms of like Valley grants. So coming back to the RSU grant, you can sort of understand like what that entails. So a 60K RSU grant in $3 billion company is around that percent. So, comparing, you could gain a substantially more money or like profit or stuff, cars, whatever, yachts. You can gain by joining early, but obviously it's a gamble because most of the companies fail. I think you should never exercise stock options, just because it's like you're joining something that you believe in, and that company gives you trust back. And so I heard stories about people kind of not exercising their stock options because the price was kind of big. Turns out, after 2 years, it's suddenly like 30 times more worth, potentially maybe. So I think you should always exercise, and you should always be thinking of like, okay, I'm getting these stock options, I will buy them eventually, which goes to pro tip number 3, which is companies should always pay for your stock options. So this can come in several scenarios. For example, companies could have like really beneficial stock option plans where they're valid, like your exercise period is valid, say 10 years after you leave. So in effect, you never have to buy them, or you should be thinking, you should be figuring out what's the strike price, what would I pay, what would I have to pay for those stock options, and kind of negotiate for maybe an increase in salary, see what you can do to always exercise. And you should be aware of, and I know this is like the stock option thing is very new here, but you should be aware of the amount that you get, like the numerical amount of options, the total, the strike price, and liquidity, like how your percentage will change when new investment comes. This is all like hard stuff, and from what I understand, like not a lot of companies share this with you because reasons. So you should be after these details. You won't get them every time, but this is important to just sort of understand where you're standing. Coming back to that like previous wonder number, which never really like I wasn't ever close to that number, like, because at the end of the day, I quit one of the companies because I wasn't taking care of myself. So I burned out. I didn't realize it at that time. I realized it when they paid like vacation leave, and that was for 44 days. So I had like 44 days of vacation, not used. Don't do that. So be wary of your mental health. Be wary of, money comes and goes. Just sort of take care of yourself first. And for the sort of the other major loss, what I came to realize was that I was looking for some more, validation maybe, or something to something that I could relate more, a product that I could relate more to, and so I said, okay, maybe I stand to gain stuff, but it's important for me to like feel happy and proud of what I'm doing, so I'll move on to this other gig. And that's it, yeah. So I hope this helps. And thanks.
Thank you. And if you have questions, please raise your hand or write a comment on YouTube. One question we have already is, how do you look at stock options going forward? So you talked a bit about your experience and how. Is it something you would expect from all your future employers, let's say?
It depends. Yeah, I think I would expect. I always ask about the program. Everything's negotiable, but yeah, I would love to. The one thing that I really sort of can attest to, and I came to realize that you actually start caring more about the global picture. It's. So somebody's doing something, I don't know if, the other department, if you don't have options, you don't have some stock, then maybe it's not that important to you. So I think it helps.
All right. And do you have any more questions? It doesn't seem so. So again, thank you.
All right, thanks.
And Simonas was our final speaker. So that's the end of our event today. Thanks everyone who came, who helped put this event up. Thanks again to the speakers. We have more events coming up in the coming months. So next month in April, we have the one with stakeholders coming up. We have 3 wonderful speakers ready to speak there to share their stories. So hope I'll see you there. And for those of you who are here in person, I welcome you to stay and enjoy the food and the drinks. Thanks.